Good morning. This is one of the toughest chapters, and I'm hoping that you invested the time in reading it. And today we're going to spend quite a bit of time working out exercises and problems. So just as a reminder, you guys need to practice the material. Otherwise, you're going to sink in this chapter, and nobody wants that to happen. So inventory, the whole chapter is about inventory. It is 100% brand new. You've probably never read about some of the costing concepts that we're going to be talking about. So that is where we're headed. I'm going to share my screen and start off with the PowerPoint because I think the author did a pretty good job on this PowerPoint. I'm going to start off by talking about what this chapter is about. There's two major parts to an inventory chapter, any inventory chapter, where it's a beginning accounting class like this or an upper level graduate class. The two challenges in inventory are the counting of the inventory and then the costing of the inventory. So the count physically determines or verifies the counts that may be taken place by perpetual records. So it verifies that the estimated count on hand is actually there. It helps determine inventory ownership because, as you probably read, sometimes inventory may not be in our possession, but it's still ours. And so we need to know what's ours and what's not. That's part of the counting issue. The second issue is usually more difficult for students and for accountants too. It's the costing issue. And you should have read about 4 major types of cost inventory flows or assumptions of cost inventory flows. We'll come across those in the PowerPoint, I'm sure. So there's 2 major issues to kind of summarize that up. There's the counting issue and there's the costing issue. Both are important. This chapter takes more of a harder look at the costing issue, but counting is just as important. So dealing with the counting issue, we've talked about this before, is that at the cutoff point, it's important to determine whether goods in transit that may not be in our physical location are ours legally. If it's ours legally, we got to include it in the count. And so again, this chapter brings up the FOB shipping, which means buyer owns it as soon as it's shipped, no matter where it's located in the inventory process, it's the buyer's. So even if it's going cross country from, let's say, New York to Los Angeles, even if it's in the middle of the country and it was FOB shipping, the buyer owns it, even if it's not in his or her physical possession. And FOB destination is exactly the opposite. The seller owns it until the point in time in which it's actually delivered to the buyer. So those are those same cutoff issues. And so I would encourage you, if you're still struggling with that, to make sure you do a couple of exercises related to who owns the goods. We're going to do one today. I think we did one in the previous chapter, but there will be questions on who owns the merchandise. Any questions on those first 3 slides? Okay, goods on consignment. Consignment was pretty well defined in the book. I use the example of walking into Michael's. Michael's is a craft store, and you'll see wreaths and Christmas decorations and things usually around the top of the store. Those are not Michael's. Those are people that have given the goods to Michael's on consignment. It's owned by somebody else. Michael sells it for them and takes a percentage or a commission, but it's not Michael's inventory, even though it's in their store. So the consignor, all the different crafters who made those goods, are the owners. The consignee in that case would be Michael's, who is selling the goods for the owner. So again, this goes back to counting. Should we count all the stuff in the store? Well, if it's on consignment from somebody else, then the answer to that is no. So make sure you understand, in as far as the accounting part goes, who legally owns the inventory. We'll have one short exercise with that. Goods damaged or obsolete. We'll focus on this slide in the second day of our class, Basically what it says is when auditors, some of you I know are going to be working in public accounting, when auditors are taking inventory, one of the things they're specifically looking for is damaged or obsolete goods. Okay, sometimes it's obvious when something's damaged. You'll see, for example, cell phones that have broken screens. Sometimes it's not so obvious to most people, but accountants learn to look for certain things. For example, if you're counting boxes of inventory and there's a significant amount of dust on top of the box, that means that inventory has been sitting there for a while, and you may want to check inside the box and make sure it's something that is still saleable. Again, we'll talk more about damaged goods next time. Obsolete goods, I think we touched upon this. The iPhone 13s are coming out in the next few days. So that makes some of the older iPhones not as saleable, and you may have to write those down to something called the NRV, or the net realizable value. So I'm going to put that slide aside for the next class. We'll be doing some exercise related to that. Today we're focusing on counting and costing. We'll worry about the damaged stuff next time. I think we talked about this in chapter 4 as well, but I'll bring it up again. GAAP says that the inventory's cost, and I'm putting cost in quotes because we're going to talk about 4 costing methods today, but that the inventory's cost is all expenditures necessary to bring that item to saleable condition. Kind of reminds you of the fixed assets that we talked about in chapter, I can't remember the chapter from Accounting 100, but the cost of a fixed asset is anything necessary to get that asset ready for its intended use. The same thing with inventories. It's all the cost necessary to get that inventory in a saleable condition and ready to go out the door. So we already saw some of these things in chapter 4. So this is a recap. The inventory cost is what it physically cost you. That would be supported by invoices, less any prompt payment discounts or trade discounts that you took, plus any other costs that were incurred in getting the inventory to you. Some of the items or some of the costs that we see are shipping. Okay, we know that from our last chapter. Storage, if you have to pay to store the inventory somewhere, that becomes part of the inventory's cost. And other common things like if you need to insure it in transit, or if you're importing it, you would have to pay duties, taxes, and the like. All those are costs necessary to get the asset ready for its sale, or what the book uses, saleable condition. And so all of that would become part of the inventory cost. So there's a lot of information in these slides. Any questions through the 6th slide that I'm showing you? Okay, I'm not going to spend too much time on internal controls, but they are important. The reason I'm not spending too much time on it is because the author did a very good job of describing some of the physical controls. Again, I mentioned I was just talking to someone at a Big 4 firm, probably now, I think it was last weekend, and she was getting ready to supervise her first inventory, and she was extremely nervous. And she had good reason to be nervous because we've talked about the fact that if there's an inventory error, inventory is wrong, cost of goods sold is wrong, and because the ending inventory becomes the beginning inventory, as you'll see in the next class, counts and numbers are affected for 2 years. And so that's why when you go out on inventories, it's one of the few days where you'll see the suits. And when I say the suits, I'm talking about the partners of the firms. Oftentimes, especially if there's a buyer coming into play, somebody that's looking to buy the company and part of it's going to be based on inventory counts, that's when you'll see the partners come out and make sure that the inventory is being supervised properly. So you can read through these internal controls. Of course, you guys can ask me questions about any of these as you come across them. One of the things that I remember has to do with this one. You want to make sure that inventory actually exists. And I actually had a partner come out on one of my inventories. I worked at a Big 4 firm. At the time, it was a Big 8. It was called Coopers and Lybrand. It's now PricewaterhouseCoopers, but nevertheless, I remember this day clearly as it was yesterday. We were doing a shoe company, and the shoe company was going to be purchased by another entity, another company. And so I felt really good about supervising the inventory. This happened to be in a warehouse that was probably, the warehouse was probably 2 to 3 stories tall. And I was going around doing cycle counts and I was confirming the existence. When the partner came in, again, shoe boxes lined up 2 or 3 stories tall. The partner came in and pointed to a box near the bottom and said, "I'd like to see the shoes in that box." And I'm looking at him like, does he realize that a forklift needs to come over and move all the other boxes on top of it so that he could look at that specific shoe? And I'm thinking to myself, is he crazy? Right? Well, he had a lot more experience than I did in things like this. The forklift came over, they opened up the box, no shoes inside. And so systematically, we started to look at the bottom layers of boxes, no shoes inside. So what was going on is somebody was trying to perpetuate a fraud by overstating the inventory because that would increase the price to the company that was getting ready to buy the shoe company. I learned a lot that day. Sometimes I think we learn our best lessons, I think, by experience. So that's just another example why it's so important to know how to correctly count an inventory. And it is important to have verification of these counts. And as I just found out that day, not just by a supervisor, because I was a supervisor on the audit, but even from sometimes managers or partners that know more than you do because of the experience that they have.
Professor?
Yeah.
So they make the accountants do the physical count?
They make the accountants supervise it, which means they come right behind the people or they observe the people that are counting it. Yes, absolutely.
Oh wow, that's interesting.
Yeah, and that's why, because inventory is a moving target, Samir, it's constantly changing. That's why many times you'll see the suits out there, because the inventory that they're taking, let's say they take it at the end of the month on September 30th, that inventory is going to be different because the buyers and sellers are moving the inventory all the time. And you get one shot on that cutoff date of confirming that the counts and the costs are good. The counts are the ones that are hard to create because the inventory is constantly moving. The cost, you always have invoices and things to fall back on, but absolutely, inventories need to be verified by auditors. So the auditors aren't doing the initial counts unless someone's paying them to do it. But usually it's the staff people that work at the company. The auditors are coming right behind them to make sure that everything was counted, to do cutoff confirmations, to make sure that if there's inventory in trucks on the way, that even though it may not have been there on the day that the count took place, that it was included in the counts. Yeah, and I will tell you, as a supervising auditor, that was always the most nervous point of audits for me because it does have an effect on all 3 statements. So yes. Okay, here's what we're going to focus our time on today, because I think this is probably the most challenging part of the chapter. So counting's important, and you just heard me talk about how counts can be off and how someone, if they're trying to perpetuate a fraud, can easily count the inventory incorrectly, right? But the challenging part of this chapter is not the counting, it's the costing. And so we're going to spend most of our time today on these 4 methods of counting and costing. This is costing inventory. And there used to be a chart in the book, and I didn't have time to go back and look. FIFO is by far the most popular inventory right now. I do see that shifting as more and more computer systems are becoming less and less expensive. I think weighted average is eventually going to take over the popularity of FIFO, but right now FIFO, first of all, makes the most sense from a physical standpoint, right? The first ones in are the first ones out. So I always tell students when they're thinking about these costing methods, I would picture yourself in a store, wherever you grocery shop. I was at Sprouts or Smart and Final this weekend, so one of those pops in my head. But first in, first out is how they normally stock inventory in grocery stores. It means that, for example, on the milk, they're stocking it from the back so that the first ones in, the ones in the front, are the first ones sold. That's what makes most sense from a physical flow standpoint. Now, the inventory method that a company chooses does not have to match their physical flow. It's just a cost assumption. And I think the author did a pretty good job of explaining that in the chapter. And I think the best practice for this is to jump in and get our hands dirty. So let me give you an overview of these other ones, and then we'll jump in. Last in, first out, LIFO makes absolutely 0 sense from a physical standpoint, right? And so the picture I want you to envision in your head, that would be like stocking milk from the front, right? It makes no sense because the stuff in the back is sometimes stays there for years on end in the form of cost flow assumption. Because if the last ones stocked in are the first ones taken out, that means you got a lot of old costs sitting in the back. Now, if it was something that spoils like milk, I mean, that's a gross thing to think about, but that's what happens as far as the cost flow assumption goes. LIFO makes absolutely no sense. It was developed during an inflationary period, and nobody had any money to pay taxes because everything was so expensive. And so some people got creative and came up with a way to save on their taxes. And since it was during an inflationary period, last in, first out, if you think about that, means that the last ones in, the last ones purchased, the ones at the highest prices, were going to be the first ones sold. Okay, what did that do? Cost of goods sold. You can think about what effect that had in it. Cost of goods sold was really high. It was at the most recent prices. And when cost of goods sold is high, net income's lower. So they were trying to save on taxes. So then Gap came around and said, what are you guys doing? This doesn't make any sense, LIFO. But they had enough companies pushing for it that Gap said, okay, we'll allow it, but you have to use it going forward. You can't make up your mind that you want to shift inventory cost flow assumptions. Weighted average, the reason I like it is because it always falls between the two. It takes out the highs and lows in the economy. So I think more and more people, as we have software programs that calculate this for us, will be switching to weighted average. And then the one I left blank is because it's not used by a whole lot of people. Specific ID, think about lower volume, very high cost items, like, for example, cars, right? You can go on a car lot and you may see 3 Highlanders. I use that because that's what I drive. You may see 3 Highlanders on the lot, but they'll be very different. One might be souped up and have all the bells and whistles. Another one might just, have the bare basics, just power steering and maybe air, but they're very different costs. And so specific ID is where they actually go back and pull the invoice for that specific Highlander. And that's where the cost comes from. So it's highly accurate, but it can be very time consuming to go pull the specific invoice for these different inventory products. Another company or another type of industry that uses that, jewelry, right? Because all diamonds are different. And so if I was taking, I'm trying to think of a jeweler, the names are escaping me, but you walk through the mall and you see these jewelers. One diamond might look visually without a microscope or without their loupe that they look through, might look like the other one, but they're very different and the cost can be extremely different. And so rather than just use FIFO or LIFO or weighted average, they'll go pull the specific invoice on that lot of diamonds. So questions on what those 4 inventory methods mean? There's going to be very different results that you're going to see. Okay, then let's look at one or two more. I really like this slide. And so if I were taking notes, I would write exhibit 5.2 in your book. I think this is an excellent slide because it visually gives you a picture of what's going on. First in, first out. You see right here that cost looks like they are going up from 45 to 65 to 70. So first ones in are the first ones out. They start at the bottom, and I'll use this concept today called a bucket. They start at the bottom of a bucket and they start pulling from the bottom. So cost of goods sold is made up of the oldest prices, right? As it should be, I think, in a regular cost flow environment. And what's left on top are the most recent prices. This is a period of inflation. Okay, how do I know that? Because I see it going May 1st from 45 up to 65 up to 70. And so in times of inflation, you're going to see that FIFO has the, let's see, I always have to think backwards on this. FIFO has the lowest cost of goods sold and the highest gross profit. You'll see that happening in the little income statements. Okay, LIFO means you start from the top of the bucket. And what happens is the stuff on the bottom can remain there for a long time. That's why it doesn't make any sense from a physical cost flow, but remember, it doesn't have to. A company chooses a costing method and then sticks with it. What I wanted to show you on this slide is that weighted average always falls between. So you'll see that the gross profit here is between the FIFO and the LIFO. So again, this can be one set of transactions. If you have 4 different companies recording exactly the same transactions using different costing methods, you can wind up with 4 different income statements. And that's why this chapter is so critically important to understand, because it affects all 3 financial statements. And because these ending inventories become the beginning inventories, it actually affects it for 2 years. We'll see that in day 2 next time. But we're going to spend the rest of our time focusing on these cost flow methods and making sure that you have a good understanding of how they're done. So let me stop for a second, see if you guys have any more questions.
Yes, Professor. Is the reason why we get different outcomes because the cost is fluctuating? If it was stagnant, it wouldn't matter, right?
Exactly. If there was no price increase or decrease, it wouldn't matter. So if all these items came in at $45 and prices didn't change at all 3 would give us the exact same answer. Because it wouldn't matter if you started from the top or the bottom, they're both at 45. And so you would have exactly the same results. Demir. But as we know, right, just from going grocery shopping, I don't know about you guys, but I've noticed a huge increase in just grocery bills here lately because everything seems to be going up right now. And we'll see what the economists say, whether we're in an inflationary period or not. I happen to think we are, but the numbers are always months behind. So I think we notice that in our own pockets, but that's a good point. If there were no cost changes, there would be no need for these inventory cost flow methods because they would all be the same. Okay, here's what I'm going to refer to as the bucket. I'm going to draw a picture around this, right? And you'll hear me refer to this bucket concept because here's what I know to be true. I know that all the inventory goes into this physical bucket. I'll use my coffee cup here. All the inventory goes into this bucket, and the inventory is going to wind up in one of 2 places. If it's sold, that means that it's come out of the bucket and it's going to be in cost of goods sold. If it's still left, it's going to be sitting in ending inventory because it's unsold. But at all times, the sum of these 2 have to match back to the bucket. I'm going to prove this to you, but I want you to think of this concept of the bucket. It will help you check your work on exams because once you've calculated, I'm going to use T accounts for doing inventory because I think they're very helpful and they're a lot easier to remember than Connect's so-called exhibits. I can always remember what a T account looks like. But one of the things I'm going to do to check myself at the end, the ending inventory and the cost of goods sold, no matter whether you're using FIFO, LIFO, weighted average, or specific ID, they always have to match the bucket. And that may not seem too clear now, but it will be clear after we do a set of exercises. So I think we've done enough summarizing of what the first part of the chapter is about. Any questions before we jump in and try one? Okay, then of course, all these things are in your modules link. And so we're going to do one quick exercise on counting, and I'm going to write that at the top. There's two issues in inventory, counting and costing. Those are the two major ones. This is one of the few that we'll be doing on the counting. Does the inventory belong to the company or not? The rest of today we'll be talking about costing. So I wanted to put one in here to give you an idea of what a counting problem may look like. So basically, when we're counting, we're asking ourselves, does the company own the goods? Should they be counted or not? Okay, so number one says, at year end, bar company had shipped. Okay, so right now, what they just told us, if they're shipping it, they are the seller. Okay, I'm going to write that. Bar company had shipped 12,500 of merchandise, FOB destination. What FOB destination means, before I read anymore, is seller owns the goods until they are delivered. Okay, so here's what this question says. Which company should include the 12,500 of merchandise in transit as part of its inventory? The answer to that is the seller. The seller is bar. So I'm going to put the seller, bar, in this case, needs to include the inventory in its year-end count, even if the inventory is not physically in its store. Okay, why FOB destination means seller owns the inventory until it's delivered. So in transit, that's the wording that this problem used. So in transit means the seller owns it. That's number one. Let me wait for a second, give you guys a chance to think about that.
Yeah, Professor. So if something gets lost in transit, would that be considered shrinkage?
So normally what they would do is they would make a claim with whatever shipping company is in charge of it. So the seller would count it and then they would resolve it, hopefully with the, like if it's UPS, whether it's FedEx, they would probably do an insurance claim and get that money back. But if they can't, then that would be a shrinkage cost.
Okay, that popped in my mind. So
Yeah.
thank you so much.
Yeah, you're welcome. It's a good question. Any other questions? Okay, let's look at two. Paris company has shipped 20,000 of goods to Harlow. Let me go, close my email so that you guys don't have to listen to the beeps. Give me a second. Okay, now hopefully I can get back to my Excel spreadsheet. Okay, there we go. Paris company has shipped 20,000 goods to Harlow company, and Harlow has arranged to sell the goods for Paris. Okay, so Harlow has arranged to sell the goods for Paris. Okay, so I'm going to read it one more time. Paris has shipped 20,000 goods to Harlow. So Harlow has the physical goods in its hands, but that's not who it belongs to. It's back to that Michael's example. Michael's has the physical goods in their hands, but it's not theirs. So who should be counting it is whoever owns the goods. In this case, it's called the consignor. Okay, so this question asks you, who's the consignor and who's the consignee? The book does a pretty good job of describing the difference. So Paris Company has shipped the goods to Harlow, and Harlow is going to sell them for Paris. So Paris is the consignor, and Harlow is the one who's going to try and sell them on behalf of Paris. So who should count the inventory? Again, it may not physically be in their presence, but the consignor is the owner. They're the ones that need to count the inventory. So one of the things you always ask clients out here on audits is, do you have any inventory that's located in some other warehouse? Sometimes you'll see displays when you walk into stores, and the displays are someone just trying to move goods. Sometimes they'll run test sales of goods. It may not even be the companies that you walk in to see. But whoever owns it has to count it. That's why that legal ownership is so important. So that's the one exercise I didn't want to hear when we got to a test question, like on a multiple choice question of who owns the goods. I didn't want to hear, well, we didn't do that in class. So I threw at least one in here so that you guys could get some practice with that. Most of the counting issues focus around the FOB shipping, FOB destination. And again, even though you may not see inventory on the floor, it still needs to be counted if that person owns it. That's what I wanted to get through your heads on that exercise. Okay, someplace in your notes, you can, this will be a 10 point, at least 10 point test question. So the major challenge in this chapter, at least for the first half of the chapter, is the costing. Right? There's 4 different costing methodologies. A company will choose one and they'll stick with it for consistency purposes. And our job on these questions is going to be to make sure, number one, that the bucket balances. And I'll give you an example of what that bucket is here. But the bucket has to balance. That means that cost of goods sold and the inventory always have to total up to the bucket. And on this one, we're very fortunate that the bucket has been given to us. Here's the bucket right here. I'm going to put a visual picture around it. That is the bucket. That is comprised of all the goods that we purchased and what the total cost of those goods that we purchased was. So in this bucket is 380 units. And we spent a total of $19.50. What we're going to be doing in this problem is figuring out how much we should assign to the unsold units, which would be sitting and ending inventory, and how much we should be assigning to the cost of goods sold, the units that have already been sold and are not in inventory. No matter which of these 4 costing methods that we use, the bucket always needs to come back to the $19.50. Okay, now we know how many units were sold. They tell us here that there was 180 units sold. So we know then that if there was 380 units in the bucket, and 180 units are sold, we know that there must be 200 units sitting in ending inventory, because again, they got to balance back to the bucket, count wise and cost wise. So although they give us a specific order they want us to do these in, and what I'm referring to are these directions. It says the company uses a perpetual inventory system. That is the one that we're studying in Accounting 101, the perpetual one, which means every in and every out needs to be tracked. So here's what they want us to do. Determine the cost assigned to ending inventory and to cost of goods sold. So there's that bucket concept using A, specific ID, B, weighted average, C, FIFO, and D, LIFO. And they want you to round the cost to cents. That means we'll be using dollars and cents. And then they give you some information for specific ID. Okay, well, I'm not going to do it in that order. I want to start off with FIFO and LIFO first because they are the ones that are most heavily used out in practice. So I'm going to do all four, but I'm going to start off with FIFO here. And what I did right before class, I went and snipped this little table here so that I could move it up and down as I did the work. So I wouldn't drive you guys crazy with moving my items up and down. So what I'm going to suggest you guys do, and please, 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 for this chapter, it's critically important that you do these problems in your homework first on a piece of paper and then transfer them over to Connect. If you don't, you're going to get yourself all fouled up and probably in a confused mess. I'm going to teach this using a T account. The book is going to teach this using like 6 different columns. I just think a T account is much easier because here's what I know. On T accounts, let me press the space bar before I hit the plus. Purchases are going to go over here and cost of the goods sold are going to go over here on the credit side. So I know that as long as I keep an organized, methodical track of what's going into this inventory account, I should be able to do this no matter what the author throws at me with the comfort of knowing that whichever method I use, when I add up both of these sides, when I do the purchases, or excuse me, when I do the ending inventory and the cost of goods sold, I better wind up with this bucket cost of $19.50, no matter which of these inventory methods I do. Okay, so FIFO, think back to the bucket. The first ones in are the first ones out. That's going to be my starting point, even though I know it's letter C. It is most often used. It makes the most sense. You think about filling up a bucket, you are going to take the first ones in the bucket. All right, so here I'm going to put in a date. And so that Excel doesn't throw me into a date loop, I'm going to press the space bar a couple times before I put the date in. So the date is 1/1. Of course, it did it anyways. I'm going to put an apostrophe in front of the date. So there's the first date, and we started off with beginning inventory. So I think I'll put that even here, beginning inventory. And what did we do on beginning inventory? We had 140 units at $6. That's what we started off with. And the book even gave us that information. They told us what they came up with. Let's see, I must have not done that right. 140 at 6 is $840. There's the first layer of my bucket. Okay, 840. By the way, as we work through these, it is the sales that causes these numbers to be different. It's not the purchasing side, because remember, the purchasing side is always reported at invoice cost. It's a hard number. We could go back and trace that to invoices. What throws these methods off are the sales side of the house. Okay, so then what happened next? On 110, and here's where it gets dicey. We only have one layer, so it won't be too dicey here. It's when we have more than one layer where it gets a little challenging. On 110, it said we sold 100 units. Okay, I don't care about that retail right now. I'm going to cross that off right now. That retail price will go into the sales account. What I care about, though, remember what we're calculating on this side of the T account, the cost of goods sold. Well, if we sold 100 units, we only have one layer right now. They must have come out at $6 because that's all I have. And so what's sitting on that side is 600. And then every single time I would encourage you guys, because I know what's coming up, I would encourage you guys to foot this every single time. So right now, sitting in inventory, I have 40 units at $6. Okay, how do I know that? I had 140 and I sold 100. So now I'm left with 40 at $6. That means there's 240 sitting there. Okay, let me stop Any questions with these first two line items? Okay, then I'm going to go on. Then on January 20th, we had another layer in here. We had 60 units at $5. Okay, they even totaled it up for us. They won't always do that. Now I'm sitting here with another 60 units that I spent $300 on. Again, I know what's ahead. If I were you, I would take a balance after every single sale and every single purchase. That means every single time you do this, I would take the time to balance it out. So now I'm sitting here with 100 units at 540. Okay, now because that might get confusing, I would take the time again to write down somewhere in parentheses how you came up with that. Okay, looking at my layers, that's 40 at 6 and 60 at 5. I'm just doing this to keep track of the so-called bucket because that's going to become really important on the next sale. So somewhere, whether you write it nice and neat or you scribble it out, someplace keep track of the layers, because remember what I said, it's the green sales that represent the challenges, not the purchases, but the green sales. And you're going to see what I mean now on the next item here where we sell 80 units. So any questions on that so far? Okay, here comes the challenge, and this is where it gets different, because now we have more than one layer of cost. As Thamir just reminded us, if the cost didn't go up, if the cost stayed at $5 or $6 the whole time, we wouldn't be having these issues. But the costs are changing. In fact, this looks like a period of deflation, because the costs are going consistently down. If you look at our bucket from 6 to 5 down to 450. So costs are going down during this time period. And now comes time for this 80 units in sales. So I'm going to date this. This is 125. And here comes my sale. My sale is at 80 units. But I'm going to put a question mark there, because 80 units means, am I going to pull from the top of the bucket or am I going to pull from the bottom of the bucket? Okay, well, this is where we need to remember the cost flow assumption. FIFO, the first ones in are the first ones out. Here's the first one in, was that 40 at 6, that 6 layer. So how am I going to calculate that 80 units there? I'm going to take the first 40 at 6. And then what do I need to bring it up to 80? Right? It's 80 units in total. I better put this in a different color so you guys can keep them straight. Hopefully I can put that in red. I can't. The first 40 were at 6. So now I've used up this layer right there. And that means to bring it up to 80, I need 40 more out of this layer. So the next 40 are going to be at 5. Okay, so before I even do that math, I'm going to go over here and put in this last T account balance right now. So I had 100, I sold 80. That means I have 20 left. And those 20 left are going to be at that $5, that part of the bucket that we haven't used yet. So it's $100, but let me go back over here now and fill in this cost of goods sold. The 40 at 6 would be cost of goods sold at 240, and the 40 at 5 would be cost of goods sold of 200. And let me stop, because the sales are the tricky part. The first ones in are the first ones out. So the first ones in are the first ones I got rid of here. I got rid of that first layer. I used it all up. And to make up the 80 that I sold, now I had to eat into the second layer. How far did I eat into it? I used up 40 of those. That means I have 20 left. The sales are the challenging part. That's why they're in green. Okay, hearing no questions then, I got one more transaction on 130. I have a purchase, and the purchase is for 180 units at $4.50. They already were nice enough to give that to us in their chart, but that won't always be the case. Let me let Excel do its thing. Matches with the 810. And so here is the moment of truth. My ending balance is 200 units. Okay, that's what we were expecting, right? At the start, when we created our bucket, we knew that there were 200 units left. Okay, here's our little bucket. We knew there was 200 units left. The question becomes the valuation. Well, I can just split this. My ending inventory is going to be at 910. And my cost of goods sold is going to be the sum of this column. So my cost of goods sold, we know how many was sold. We know that from the bucket that we did. What's missing is the valuation. I'm going to sum up each one of those costs. And this is, again, where it varies. When I do that, I come up with 1,040. How do I check myself? This is where the bucket comes in. The sum of these two have to always balance back to the bucket. Okay, do they? We'll take a second. 910 plus 1,040 is 1,950. That's a good check on whether we've done our math right. And the problem may also ask you for the number of units, okay, in which case I could add those up, 100 plus 80 plus 40 plus 40. And we already knew what that was at the get-go. In fact, I'll do it. 180, 220, I think it was 260, if I'm not mistaken. Let me go.
Professor, I don't think you count the 80 because that was just a visualization of the 240s.
Oh, you're right. Thank you. Thank you. That's why I did it in another color. Thank you very much. You're right. So it would be 180. Thank you. Thank you. It's exactly why I did it in another color. And I'm going to go check my bucket. I would have caught myself, but Thamir, I'm really glad you caught me. I do have 180 units and it does match. So you might even, on a piece of paper, you may want to put that in parentheses so that you don't do that on accident. Always check the bucket. That would be my advice to you for this chapter. When you're done, always go back and check the bucket. So we can see that we accounted for all 380 units that was in the bucket. And we see that we split the cost out between ending inventory, the stuff that's left, and cost of goods sold. They can only go one of those two places. And then as Thamir mentioned earlier too, the shortage issue we deal with through a journal entry later. That's FIFO. That is the most widely used method right now. Any questions on that? All right. Then let's go over to the one that makes absolutely no sense from a physical standpoint, right? Again, this would be like stacking milk from the front. Nobody does that because there'd be spoilage in the back, but it's a cost flow assumption. It's something that's Gap has come along and told us that we can use. You got to stick with it. You can't just flip flop it because that would throw all the financial statements off. It would take away the consistency principle in accounting. So you got to stick with it. If you do decide to change, there's some restatement issues that are above the scope of this class. Okay, so here we go again. LIFO, the last one's in. So over here on FIFO, we started at the top to start using up the amounts that were in the bucket. Now under LIFO, we're going to start from the bottom and you're going to see completely different results. Okay, so again, I'm going to remind myself that this is an inventory T account. The purchases come in as debits and the sales go out at the cost of sales as credits. So once again, I'm going to write in January 1st, beginning inventory, and I may want to put another column in here. I'm going to insert a column just so I don't have to squeeze this in. And I'm going to move this over here so we can see it a little bit better. We have 140 units at $6, and we already know that's $8.40. Okay, so far nothing's changed. And then on January 10th, we have our first sale. And since I only have one layer, this won't change either. There's only one layer to begin with. We sold 100 units. I'm looking over here at this green. We sold 100 units again at a cost of $6. Okay, so that would still be 600 coming out. So far, no changes because we only have the one layer. So let me go ahead and balance this out. I would encourage you guys to balance it out after every single transaction. I think you'll be much more clear on that. That means we have 40 units at $6. We still have the same 240 that we had on the previous one. Okay, here comes in the second layer that will throw a wrench in our sales when we get there. So January 20th, we bought 60 units at $5. So again, we spent 300. Again, I'm going to balance this out. And right now we have 100 units and we're still sitting at 540. So you might be looking at the previous problem and you might be saying, hey, you know, what's the deal? Nothing's happened yet. Okay, this is where the sales are the ones that throw the loop at us. So I'm going to write myself again a note in parentheses over here, just reminding myself what is made up of those 100 units. 40 at 6. And 60 at 5. That's how that came to me. Put it in the correct order. Okay, here's the most challenging part of any test question. It's the sales that are involved when there's more than one layer of inventory. Right now we have 2 layers. And so that's where the challenge comes in. So let me write this down. On 125, we sold 80 units. But again, here comes the question, how much? What layer should we take that out? Okay, remember the name. Last one in is the first one out. Last one in is the first one out. That means I'm going to start from the bottom here and work my way up. So I would, again, I'm going to make this red so I don't do what I did in the last one and double count it. We had 60 units at 5 come out. And that means to get it up to 80, I'll make it red in a second, we'll have to take out 20 more units, this time at 6. Okay, let me make that a different color so you can see it. And so if I'm visually looking at this, the last one's in, I've used these up now, they're no longer there. And because 60 wasn't enough to bring me up to the 80 that were sold, I had to take 20 out of this. And so what's left then is still 20 units, but at 6 this time. My balance here is 20 units at 6. That $5 layer is gone. So let's go fill in this math. 60 times 5 is 300. And 20 times 6 is 120. I have my balance. Let me put a total line in there. Questions on that sale, because right there, that transaction is what is differing between these different methods. Okay, let me finish this up then. I had that January 30th purchase. where I bought 180 at $4.50. And so now I'm ready to calculate. It's not the quantity that is changing. I want you guys to notice that. My ending inventory is still 200. That's not changing. What's changing is the value I'm going to give to it. So let me finish this math. Here it was 120 and the 180 at 450 they gave us, but let me go ahead and calculate it. When I add that up, that is my ending inventory. That is my answer for ending inventory. How many units did I sell? Again, still 180. That's not changing. It's the cost that changed. Now I'm going to add those yellow numbers up. And then the last thing I will do is I will check my bucket. What the heck does that mean? Does the sum of these amounts here balance to your bucket? 930 times, or not 930 plus 1020 is 1950. Let me go look at my bucket. I balance to my bucket. That gives you some comfort that you've done the math right. Now, earlier, I told you that in times of inflation, LIFO gave us the very lowest net income. That was the whole reason it came up, because nobody had any money to pay taxes. Gave us the lowest net income. In times of deflation, right, when the costs are going down, it's exactly the opposite. It flips. So you're going to see that this gave us the lower cost of goods sold, which would give us the highest net income. And it's hard to mechanically think through what's happening to the bottom line. And it's not something that you can just do like that. You got to follow it. So one of the wrap up problems, once we're done doing these 4 inventory methods, we'll go to the next exercise here, this next tab, and we'll take a look at what happened to the bottom lines or the gross profit lines, because the effect will be the same. So we'll wrap this up and we'll see what happened in periods of deflation, which means the costs are going down. How do I know it's deflation? I remember quite a few people asking me that last semester. If we're looking at this, it went from 6 to 5 to 450. So costs are going down over a 1-month period. You know, technically you can't call it a deflationary period, but in terms of the costs going down, that's what the author's talking about. Okay, let me stop, because that's not easy. There's a lot of things going on. Many people, including myself, consider this to be a very tedious chapter. You have to be very careful, but the effects, I can't think of an effect of an error being so big as it is in inventory issues. Again, that's why you'll see the suits out there. Thank God the suits came by on my day to supervise an inventory, because I would have made a huge mistake never thinking about the bottom levels of boxes being empty. All right, if I don't hear any questions, then let's go on to weighted average, which, remember, the reason that I like it is because it's always going to fall between these two. In other words, ending inventory here was 910 and ending inventory here was 930. Weighted average is always going to fall between those two. It takes out the highs and lows and makes it a more constant rate of cost of goods sold. So we're going to see that next. Okay, not hearing any questions. And if you do have questions, please ask. But not hearing any questions, let me move this up. And we will use that to do weighted average. And again, I think I needed an extra column in here. So I'm going to go ahead and insert that now, just to give me some extra space. So first one, beginning inventory. We had the same 140 units at $6. Okay, that hasn't changed at all between the three. And that first purchase is not going to change at all. Oh no, we have a sale next. The sale's not going to change because we'll only have one layer, but we'll go ahead and we'll write that in. On January 10th, we had a sale of 100 units at, we only have one layer, has to come out at 6. So let me go ahead and put that in. So we still only have one inventory layer so far. What do we have right now? Let me put balance. We have 40 units at $6 a piece. $240. Hope you guys have noticed that hasn't changed between any of the 3 that we've done so far. It's not the purchases that change this. It's the sales that change this. Purchases are hard dollars and cents. You can trace it back to inventory, to invoice content. What changes is the way or the method that we use to track the sales. Okay, so we got the 10th down, going back over here. Now we're on the 20th. So let me put that purchase in. And on that purchase, we had 60 units, which is going to create a second layer. 60 units at 5. That would be the 300. Okay, here's where weighted average is going to change. Put a total line in here. All right, here's what you want to do on weighted average. You want to have the number of units in here. Excuse me while I silence something. 100 units is what we have in there at 540. Every time you do a balance, you want to go in and calculate the average. Okay, let me write that again. I'm going to get this in your notes. Every time you have a balance, go in and compute the average. Okay, well, how do you do that? I'm going to do it in red right here. The way that you do that is you take the 540 that's in there and you divide by the number in there, and that will give you the amount that sales will come out of. Okay, so let me go ahead and do that on my calculator. You can probably do it in your head, but 540 divided by 100. There is my average cost of inventory on hand. That's where it gets its name from, weighted average. It takes out the erratic highs and lows. And so what's going to happen on the next transaction where I sell those 80 units, they're going to come out at 540. Okay, so 125. We have 80 units coming out at 540. 80 at 540 would be 432. I'm going to do my balance again, but let me stop. See if you guys have any questions.
Yes, Professor. So when computing the average, it's always going to be however units you have before the sale, right?
Yes.
Okay. All right.
Yes.
You just want to make sure.
Yep. So that way, if you do a balance every time, you'll be ready to do the sale. And that would be the extra work that I would tell you guys to go to. Keep that balance consistent, get into the habit. And that's why I want you guys to do your homework on a piece of paper. Get into the habit of always doing the balance, the cost per the balance each and every time, and you won't mess this up. By the way, this is the one where you're most likely to make a mistake. So now I can calculate what's in there. It's the 540 less the 432. Another way of saying it, it's the 100 units less the 80 units. So I still have 20 units. And in keeping with my own recommendation to you, I'm going to calculate the balance just so I'm ready in case another sale comes up. Now you might be saying, well, we don't have any more sales. I want you guys to get into a consistent habit of doing it the same way each and every time. That way, when you develop those habits, you won't find yourself running into problems. So I'm just going to put this in red. My average would be 108 divided by 20, just to kind of keep tabs on that, even though we don't need it for this one because we didn't have another sale. I want you to get in the habit of calculating that. So 108 divided by 20, there's that 540. We knew that was going to happen, but I want to create consistent habits. And so to wrap this up, we'll do January 30th. We'll do a purchase. We'll do a purchase of 180 units at 450. Okay, they did the math for us, but I always like to just keep it consistent. And just like I told you before, get into the habit, because a test question might say, what would the next sale be recorded at on a per unit cost of goods sold basis? I'm going to follow my own advice right here. And I'm going to sum this up because I do need my ending inventory. We'll make sure the bucket works first. So here's my ending balance. We have my 200 units. The amount is 918. Okay, we knew it had to be between FIFO and LIFO. That would be the very first thing I would check. And as far as cost of goods sold, we have our 180 units. And I'll put these yellow items over here. That will also be between the two when I sum this up. It takes out the erratic curves. So let me check my bucket first, right? How do you check your bucket? I'm going to add 918 and 1032. And I do get the amount of my bucket up here at the very top. I do get 1950. You guys double check. When you add that up, you should get 1950. We know it's accurate. The last thing I would do down here is I would calculate that average, because I remember multiple choice questions popping up that asked you what would the next sale be recorded at on a per unit basis. So 918 divided by 200, if I had to answer that, the average would now be 459. Okay, check your bucket. Here's my bucket. My bucket is good. Check and make sure it falls between these two. Okay, it does. 918 is between 910 and 930. So far, so good. Any questions on that weighted average?
Just to be sure I'm getting it right, every subsequent purchase in between sales influences the fluctuation of the average, right?
Yes, sir. Exactly right.
All right, thank you.
You're welcome. Anybody else? Okay, then let's go back and do this specific ID. Okay, why did I wait till the end? It is not used. I think the last time I checked, and I should have went and looked before class, I want to say 4% of companies use specific ID. And again, it's usually used for low volume, high dollar items where the units are significantly different. So in class, in our lecture today, we use examples of cars or possibly diamonds or other jewelry. This is where if I went and I bought a Toyota Highlander off the lot, they would go pull the actual invoice for that specific Highlander that has that specific features. And so they'll have to tell us what's what here. And so, by the way, this one gave people a lot of trouble on the homework. So I want to make sure you understand it. So here's what it says. For specific ID, ending inventory. So we're looking at this right now for specific ID. Ending inventory consists of 180 units from the January 30th purchase. Okay, so this layer right here, that was all left. Okay, so on this inventory T account, there's really two sides to it. It's what's left and what must have been used up. So they're going to start off with the January 30 purchase. Any order you want, what's left from the January 30th purchase. They told us, I have to read it again, ending inventory consists of 180 units from that January 30th purchase. So I'm going to put that in 180 at $450. And since those are all left, there's nothing sold out of that layer. So 0 at $450, right? If they're all left, then from that specific layer in the bucket, nothing was sold. Okay, let's go look at the next one. Remember, cars, jewelry, they're pulling specific invoices. On this next one, they said there's 5 units left from the January 20th purchase. Okay, here's the layer they're looking at. There's 5 units left. That means 55 of them must be sold. So I'm going to go put that in. There's 5 units from the January 20th purchase. So 5 at $5 is what's left. 5 at $5. Because there were 60 units here, that means the rest of them must have been sold. So there's going to be 55 times $5. Okay, and again, I'm going back to the individual item here, sentence. They had 5 units from the January 20th. We got that. And then the last thing they tell you is 15 units from beginning here. Okay, well, if there's 15 units left, the rest of it, the 125, I think that is, must have been sold. So 15 units were left. Let me go put that in there. 15 at $6. And that'll be beginning inventory. So what must have been sold? Okay, again, if you look at that layer, there's 140 total. That's that inventory layer that we started with. If they had 15 left, that means they must have sold 125 at that layer. And so all we got to do is be careful on the math. I'm going to let Excel do the math. Hopefully I won't transpose a number. Demir and Julie, you're both good at watching me. So 5 at 5 and 15 at 6. When I add that up, I'll have my ending inventory. And by the way, the quantity is not changing, right? When I add these up, I should still have 200 units, which I do. And my ending inventory would be the sum of those. And as far as the number of units, that's not changing either. What's changing are these costs. So I'll let the computer do the math. This is going to be 0, of course. 55 times 5. 125 times 6. Again, it's tedious. And you're going to have to be very careful not to make silly math mistakes. I am more than happy to help look over T accounts. If you guys have questions as you're doing it, you can't get something to work, I'm going to ask you, show me your T account, not this 3 or 6 column thing that Connect uses. That confuses the heck out of me. When I'm taking a test, I can easily remember what a T account looks like. They're going to have you fill that table in, but it's much easier if you've done it on a piece of paper. So my last word of advice, check the bucket, right? When you add these up, the 925 and the 1025, do you balance to the bucket? Do you balance out to that merchandise available for sale? So remember, we had to get back to 1950. We're back there. And so that's good comfort that your math is on target. There must be questions because this is a confusing topic.
So with this one, I just want to be like super crystal clear about this one.
Yeah.
So seems to harken back to that merchandise inventory, like the cost of merchandise inventory equation,
Mhm.
where you're kind of using the cost of goods sold and the ending inventory to like kind of balance everything out to the merchandise inventory equation, the
Yes,
cost of it.
yes,
So is that a fair assumption?
it is.
All
Yeah.
right.
So in my mind, Samir, that might work for your mind because you probably can remember things better than I can. In my mind, when I'm doing inventory, I need to check the bucket. I need to check the bucket. All the inventory that was purchased went into this bucket, and it's going to land in one of two places. It's either still sitting in the bucket, which means it's unsold, that's ending inventory, or it's come out of the bucket and it's been sold. If it's come out of the bucket, that's where this inventory costing method comes in. It's not the purchases that are different. The purchases are all the same. It's the sales and the treatment of the sales where these costing methods come into play. So let's go back, going back to Thamir's question with keeping that inventory and the accounting equation in balance. Let's go back and see what effect this had on the company's income statements. So I'm going to show you the exercise, and then we might have to do some flipping back and forth. 5-5 says, compute gross profit for the month of January for Laker Company. Which method yield the highest profit, right? Does the gross profit weighted average fall above, between, or below? We all know the answer. It's going to be between, always, 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 because it takes out the highs and lows. And then it asks you a what if question. If costs were rising instead of falling, which method would yield the highest gross profit? Well, in order for you to physically see what's going on, we're going to carry over our information from the previous problem, and we're going to visually see for ourselves what happened to the gross profit. Okay, so going back here, sales are always at the retail value. Okay, so here's the units sold at retail. If we take a second to come out here to these green numbers, the first sale was 100 at 15. Okay, that's going to be 1,500. And the second sale was 80 at 15, or 1,200. So for all of these costing methods, it's not the revenue that's changing. Again, it's not the revenue that's changing. It's the cost of goods sold. So sales for all four of these are going to be 2,700. How did we get that? We looked at these green numbers. Those were at retail, and we added them up. So I'm going to go fill in the first line of my income statement at 2,700 across the board. That's what they sold those goods to consumers at. So I'm going to go back over here, and I'm going to put 2,700 going clear across the board. Those are hard dollars. You could trace those to the invoices to your customers. This is the line that is changing because cost of goods sold changes under these four different concepts. So what I think I'm going to do is, we'll go at it one by one. FIFO, here's their cost of goods sold. It was 1,040. Let me go put that in. And let me show you guys in Excel how to reference that. These are all in the same workbook. So rather than going back and forth and trying to remember, my memory at 57 is not what it used to be. If you just put equals, and then you go click where the number's coming from. So I'm going to click this exercise 5-3, and I'm going to click the FIFO cost of goods sold, and you press enter. It'll pop it in there for you. That's probably easier than trying to remember it. So LIFO, I'm going to do the same thing. Equals. I'm going to go click on the exercise 5-3. I'm going to find that LIFO number, and I'm going to press enter. And for weighted average, I'm going to do the same thing. Equals, go click that 5-3, find that weighted average number, which is the 1,032. And for specific ID, I'll do the same thing, equals, go back to the exercise we just did. I did that one up near the top here. So let me give you guys a second in case you need to go back to your work and reference it. Let me give you a second. And this is a really good example of what happens to the profit. Remember, all the same transactions. So think of this as maybe 4 different companies recording the exact same transactions using different inventory methods. Let's see what happens. Gross profit is sales minus cost of goods sold. Okay, and remember, this was in times of falling prices. Sometimes your book will refer to this as deflation. How do I know that? Again, if I go look back at the original problem, it went from 6, to 5 to 450. So you can clearly see that the costs are going down. That's not our times right now. I'm no economist, but my guess is we are in an inflationary period. Let me pull that formula across and we'll see for ourselves what happened. So in times of falling prices, the highest gross profit is LIFO. Okay, that's not a surprise because we said, in case you forgot, we said that LIFO makes no sense from a physical flow standpoint. And what happened is it became popular in inflationary times because nobody had any money. And so they were trying to get their taxable income to be the lowest it possibly could. So they came up with this crazy idea of stocking things from the front called LIFO. And so it makes sense that in times of inflation, it was the lowest net income. The reverse also happens when it reverses itself. When deflation in this case comes around, it will be the time of highest net income. So let's answer these questions. Which method yields the highest gross profit? We can look here and we'll notice that LIFO is the highest. Does the gross profit using weighted average, okay, here, right here, does it fall above, between, or below? Always between. That's why I like it. It takes out the effects of these price changes. And if costs were rising instead of falling, which method would yield the highest gross profits? Exactly the opposite. FIFO, the opposite one. So I think we answered those. Stop. It's not an easy chapter. It's 100% new. We knew in Accounting 100 what inventory was, but we didn't pay much attention to it. We did a periodic adjustment at the end where we took out the old and put in the new. That's about all we knew about inventory in Accounting 100. Now we're learning in Accounting 101 that perpetual inventories are most often used. That means they track all the ins, they track out all the outs. When prices change or when costs change, as the mirror pointed out earlier, if there was no cost change, all of these would reveal the same gross profit. But we as consumers know just from week to week at the grocery store right now, we see prices going up, 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 up. What happens is that does have an effect on both the income statement and the balance sheet. We just saw that in times of deflation, LIFO gave us the highest net income. That's a really good exercise to go back to when test questions too ask you about the effect on net income. What I remember in this brain, this 57-year-old brain, I remember how crazy LIFO is because it makes no sense to me. So how in the world did anybody ever come up with that? it was in times of inflation and they were looking for a low net income. So in my mind, in terms of inflation, times of inflation, LIFO is always the lowest. And I know that the reverse is always true, as we just saw in this one. Okay, Thamir, go ahead.
Yes. So I just had like a question. I wanted to ask after you finished all of these.
Okay,
So it says in the textbook under method advantages, outlining the the advantages for FIFO and LIFO. I
mhm.
was just getting confused on the terminology kind of used. It says that for FIFO, inventory on the balance sheet approximates its current cost, and for LIFO, cost of goods sold on the income statement approximate its current cost. Can you expound on that, please?
Yep. So Amir, do you know what page you're looking at? So I can just, instead of having to ask you a bunch of times, look at, do you have a page number by any chance on the chart you're looking at? No?
Yes, it's on 208. It's
Okay,
on
let me look.
208 and it's under method advantages.
Okay. Yeah, so FIFO, inventory on the balance sheet approximates its current costs. Okay, I want you to think about that because this was confusing for me as a student as well. The first ones in are gone. Those are the oldest ones. The first ones in are now gone. The first ones in are the first ones out. So what's left is inventory that is at the most recent cost because the first ones in are gone. So that's what that means. It is a balance sheet method. FIFO is more concerned about the balance sheet than it is about the income statement. So I don't know if that makes sense to you, but that's the way that I remember it in my head. First
So
in,
it's kind of like a projection for the next year, kind of.
no, it means that the older ones
Uh-huh.
are gone. They're on the income statement. So right now in this current year, the balance sheet is at the most recent cost. Those were the ones that were left that we would have just bought recently.
Oh, okay.
Okay, that's how I think it makes more sense to think about that because what you're asking is what was always confusing to me as a student, and people miss cost flow questions in general on the exam. So I'm glad you asked that. And then let me look at LIFO. LIFO, the chart you're referring to on page 208 says cost of goods sold on the income statement approximates its current cost. Okay, why would that be? LIFO, the last ones in, that means the ones that we just purchased recently, those are on the income statement at the most recent prices. And so our income statement is a fair representation under their eyes. The negative part of that, if you think about stocking things from the front constantly, the old stuff that's sitting in the back can still be on the books years later. So the balance sheet's outdated many times under the LIFO.
Oh, okay.
That's what that means. So they each
Oh,
have their advantages, they have their disadvantages. GAP has pretty much said that once you choose something, you got to stick with it. And Thamir, since you're an accounting major, and Julie, you very well may be an accounting major too, LIFO was almost outlawed recently. We have this thing called IFRS, International Financial Accounting, and you cannot use LIFO with IFRS. So that's something that you guys might be asked on a CPA exam, because I know you both are thinking about it. And so LIFO for the United States is allowable because we use GAAP. If they ever make a mandate over to the International Financial Accounting Standards, then LIFO companies, US companies will have to restate their inventory, those that use LIFO, because it's not allowed. That's how crazy it is.
That makes sense because in my accounting class, we learned that weighted average is now the new trend for most companies to use. And then it comes with LIFO, and there aren't that many people use LIFO anymore because it just doesn't make sense physically wise.
Yes. Yes. Now I've seen weighted average numbers creep up on the trends and techniques book. So I'm curious as to where they got their data from on it not being used as much. I've seen it creep up, but FIFO is still the one that's used by by most companies today, the last trends and techniques that I looked at. You'll get the specific ID, but it's just a small percentage of the companies that sell those very large dollar items like cars. Good to know. Samir, I hope that helped answer it. If you have any other specific questions on that, or you want to present a scenario that you're unsure about, please ask me. I personally like weighted average. I'm talking about my financial statements now, because I don't like the economy with the highs and lows causing the ups and downs. I just like consistent, probably because I'm a conservative person, consistent costing across the board. And most of the software programs now, either canned or personally developed for these larger companies, will properly base the inventory on whatever standard you tell it to do. For our purposes, it's important for accounting students that we understand the effect on all three financial statements.
Thank you for explaining that. I really appreciate that.
Anytime. And Thamir, I know that you're thinking about becoming an accounting major. So if you have any other questions, make sure we either Zoom or you, and Julie too, I know you're at USC. If you guys have any questions, make sure we Zoom, get your questions answered. Those are great questions.
Definitely.
And Thamir, by the way, I have not forgotten about your letter. I'm swamped, but I will get to it. I'm sorry that it's later than I thought.
Oh no, that's fine. That's why I sent it early, because to give time for you to work on it, you know.
Yeah, smart young man. I'll get it done.
Mhm.
Okay, 5.1b, I'm not going to do it because I think I've probably already overwhelmed you. 5.1b is more of the same. Let's see, what's something I wanted to warn you about? On 5-1b, you notice that they didn't tell us what the bucket was. They gave us the information, but they didn't directly give us the bucket like they did on the last one. So the very first thing that I would do on this problem, I would calculate the bucket. Okay, how would you calculate the bucket? You would just go through this middle column and extend it out. So for example, 20 units at 3,000 was 60,000. I would do that all the way down and I would get my bucket there. And then every time, whether it's FIFO, LIFO, average cost, specific ID, check the bucket on a test too. On a test, it's not going to tell you to check the bucket. That's my wording. It's not the author's wording. But if you have time at the end of the test, go back and make sure that whatever answer you got is correct by checking the bucket. The ending inventory and the cost of goods sold, when you add them up, have to balance back to the bucket, no matter which method you're using. Now, on that weighted average, if you get an average that is like 4 or 5 decimal places out, and the author tells you to use 2 decimal places, it's possible your bucket might be $1 or $2 off due to rounding, but that should be the only time that happens. So what I'll do is, here's what I would tell you guys to do. To check and make sure you have a good understanding of today's lecture, I would go home or turn the video off and try this one. And then as soon as Julie posts her files, and she's usually very fast, I'll come back in and I'll post the answer to problem 5-1b. And that would be a great way for you guys to check and see whether you have the first half of the chapter down. What we're going to talk about next time, and this is the bulk of the chapter we're done with, but what we're going to talk about next time on day 2, we'll talk about that lower of cost or market. What do you do when you have damaged or obsolete inventory? And our other focus will be on estimating inventory. What do you do? And I had some great experience during, and I'll probably age myself, but during the Rodney King riots in LA, when companies had their inventory burned to the ground, the business owners that had insurance needed to give the insurance company an estimate of what they lost. Well, how do you do that? You can't go in and count the inventory because it's been burned down. What you do is you estimate the inventory method. There's 2 acceptable methods for doing that. We'll go over both so that you guys can read. One's the gross profit method and the other one is the retail method. And I believe that they are in an appendix to your book. So you'll notice that usually we don't do appendices, but because this chapter is significant, and because it affects all three financial statements, we will spend some time looking at the cost and retail method next time. That's a way of estimating your inventory if it's ever needed. There's two main reasons as to why it would be needed. Either the inventory's been destroyed, or you're doing interim financial statements for some reason and you need an estimate of what your gross profit is. That's what we'll do next time. So my advice to you, whether you're in class or most of you are watching the lectures from home, after the lecture, go try this problem 5-1B on your own without any help, and then double check your answers to the solution that I'm going to post right behind Julie's solution that she's going to post today. That's it. I would use the rest of class time to go try that problem, see if you can come up with the answer. And of course, any of you guys, whether you're in the class or you're doing it online, please, please, please ask questions when they come up. There's no dumb questions. And if you're an accounting major, it's essential that you have a good understanding of this chapter and the effect that it has on the bottom line, or in our case, your author's focusing on gross profit. Net profit has the same exact effect also. So make sure you get your questions answered. That's why I'm here. Okay, anybody have any announcements, any meetings this week?
No, but I just can I just say that I encourage everyone to apply for a Cal CPA membership. It's free for students, and if you need to contact me, you can contact me through Canvas. My name is Thamir Kazwini, and I'm the Cal CPA ambassador for the campus. And so if you have trouble trying to apply for a student membership or anything like that, or if you want to know what events are coming up, just let me know through Canvas and I'll be happy to share that information with you.
Yeah, and Thamir, I'll resend, I have it in my introductory link, but I'll resend the information on how to do that. If you have a specific link that you'd like them to go to sign up for the free Cal CPA, can you, I know you sent it to me earlier, but if you could email it to me like after class, then I won't have to go searching my emails for it. You guys should all do this. It looks great on your resume. They have lots of networking opportunities. I pay hundreds of dollars a year to belong, and it also has great professional education. Once you get your CPA license, they offer lots of ways where you can go to these different classes to keep your license current.
Thank you, Professor. Yes, and as soon as I get a very solid link from Cal CPA, then I'll be sure to email that to you. Okay,
then I'll wait until I get that link from you to redo that announcement. So I'll wait on it. Okay. All right, guys. Anybody
else? Thank you so much, Professor.
You're welcome.
Thank you, Professor.
Thank you. Email with questions. Guys, I'm available. I want to help and I want to see you transfer on and go on to the next level of education. And I have lots of CPAs that have been successful in their transition. Some even teach for us now. So there's lots of things that you can do with that CPA license. If you're just wondering, you're a business major, you don't know what you want to do, and you find this interesting and challenging, okay, because I'll be honest with you, accounting is not the easiest major. But if you like the way that you can tell a story about an entity with numbers, and personally, I like the way how I can increase my personal wealth by knowing how to read numbers of other publicly held companies, I'd encourage you guys to think about it. And if you're still wondering, is accounting for me? That Cal CPA would give you a good way to explore a career path as well, for those of you that are still trying to figure out what it is you want to do. Okay, thanks, guys. See you in class Wednesday with the rest of the chapter read, and try and get to that appendix that we talked about too. Bye.
Have a good day, Professor.
Thank you.